2023 is here, but it's not been a happy start to the new year, at least for global markets. US markets ended their first trading day in the red, and the outlook looks quite grim, according to experts. In fact, even now on Wall Street, markets have erased their initial gains as new data points have emerged, and investors are trying to get a grip on what this year is going to look like. What's really bothering global markets, among other things, is the fact that the forecast is looking dismal. Well, just take a look at what kind of forecast has come out. The IMF said that global growth in 2023 will drop to 2.7%, and three big economies, US, EU and China, will slow down simultaneously. JP Morgan, on the other hand, sees 2023 growth at just 1.6%. Goldman Sachs looks at it at 1.8%. So are we looking at a tough year going ahead? What can we expect further? We're going to talk about that now with our panel. But meanwhile, just a quick look at markets right now, even as we begin. The Nasdaq down about 30 points right now. Dow Jones down in the red, about 8 points. So flat to negative, I would say. Problem areas continue to be Tesla, Apple, tech stocks impacted very badly by China. Is that going to be a big theme? Manish Singh, Chief Investment Officer at Crossbridge Capital, with me on the show. Arnab Das, Global Market Strategist, joining us. And Mahantesh Sabarat, Independent Market Expert, with me on the show as well. Welcome to all of you, and thank you so much for speaking with us. Manish, let me begin, with your take on what to expect. The numbers look dismal, but there seems to be an understanding that the slowdown in growth, which is expected to come because of monetary impact, will also see inflation easing. The first 6 months will be bad, but it might improve here on. Do you agree with that view?
I do agree, because there is a silver lining, so to say, that if the slowdown is getting priced in, as we see now, because there are more chatter about slowdown happening, then that gets the central banks active, in the sense that they're not going to be raising the rates further higher from where it is. I do believe that on Feb the 1st, Fed is going to increase rates by 0.25%. And as I told your colleague, I believe late December, is that my expectation is that is the last rate hike for this cycle, because inflation is coming down fast. I expect the December CPI print to be around 6.35. Again, it's higher than where it should be. Clearly, the target is 2%, but the numbers are coming down fast. And this is based on month-on-month number coming out at 0.1 or 0.2 thereabouts. If we were to see a negative print, then of course it'll come down quicker than that. So more and more people now do expect that recession may happen, and that gets the Fed thinking whether that is something they want to happen. So I think, and also it's about expectation. Once this starts getting priced in, that Fed is going to not be raising rates higher or much higher, because some people do still believe the federal rates are going to go to 5.5, as some people believe. Then I think once that expectation gets readjusted, you're going to see calmness in the market and a steady increase. My expectation is that we will have a positive year this year.
All right. So a positive note there. It's been a choppy start, but it's going to get better, says Manish Singh. Arnab Das, do you agree with that? And what about this fear of recession? Three major economies going into recession.
Yes, well, thanks for having me, and Happy New Year to you and everyone. Yeah, look, I think I broadly agree with Manish. I'm maybe a little bit more optimistic on the U.S. real economy. I agree there clearly is a bit of a slowdown taking shape. I tend to think, though, that the labor market in the U.S. is more resilient than people give it credit for, because of all the structural shocks and changes taking place in the wake of the pandemic, which I think we're still going through. So I think, that tightness in the labor market may translate into a somewhat more hawkish Fed path than Manish is allowing for. So I hope he's right, but I think we might have a bit more choppiness to come in the front end of the year. As to the synchronized recession, look, I think, the big picture here is that the US has been tightening and is slowing down, but has a very tight labor market, as we were just discussing. China is reopening, albeit it's a complicated reopening process because of its own success, if you want to put it that way, in containing exposure to COVID through the zero COVID policy in the past. So I think we're having a bit of a fits and starts kind of reopening process that should eventually normalize, I think probably over the course of 2023 going into 2024. So China should be on an upward path rather than a recessionary path over the course of the year. And Europe, I think, is somewhere in the middle, right? Europe has had a better second half and winter of 22, 23, at least so far, than many people expected, including myself, right? I think the very reasonable fear was that Europe would have stagflation, right? A kind of inflationary recession. Instead, what's happened is that there's been a high inflation, right? Quite high inflation with better than expected growth, essentially because most governments that matter in the Eurozone and the European Union and as well the UK have essentially fiscalized the energy price shock, right? Subsidies and transfers of various kinds have made sure that households don't have to take the brunt of the energy crisis, and many companies in many countries. So Europe, I think, is doing better than expected. Now, I think I put all these things together, and I think we're still looking at a somewhat tight money kind of environment in the West, albeit hopefully maybe easing, into a softish landing later in 2023. And China recovering over the course of the year. So I think that adds up to a kind of, as you say, a choppy start and maybe continued volatility in the coming months, but an eventually positive outcome for the global economy. Of course, there's still the war going on, and what all of that means.
I was going to come to that. Has Ukraine-Russia sort of become a footnote now? We know it's there. It's already wreaked its havoc, and incremental sort of economic pain is not being looked at. Arnab, you want to follow up on that?
Sure. Yeah. Well, I think it's a very, very good way of thinking about it, that most of the shock in energy prices and commodity prices has probably come through from the war itself.
Right.
And of course, energy prices are down even in Europe from their extremely lofty peaks, but the level of energy prices is still very high. And of course, there's still the room for further shocks as the war evolves, right? Probably nothing is as unpredictable as a full-blown war. And then, of course, there are the longer-term changes in the world economy and in the global political system that may come about because of how the war continues to be prosecuted and how it's ultimately resolved, if it's going to be resolved. A lot of scenarios, we can talk about if you want. I think the big picture here is that, like you say, we're probably through the worst of the initial economic shock, but the fact that the price level of energy is still high implies that either fiscal pressures are going to be quite strong, and that fiscalization is going to keep growth stronger than otherwise, and therefore domestic inflation pressures might be more of a challenge for the ECB and the Bank of England than otherwise. And so I think, when it comes to this question of inflation, that's really the story here, right? In 2021 and 2022, we could blame the pandemic and the war and the policy responses for both of them for the high inflation that we got. I think now we're looking at a series of pressures where domestic inflation pressures in the major economies, particularly the US, Western Europe, Eurozone, and the UK, are really what's at play here for central banks. So I think it's clear that central banks remain resolved to fight the inflation, and so that's going to cause this or continue to contribute to this choppiness in the beginning of the year.
I'll take that forward with Mahintesh. The point that in 2022 you could blame Russia, Ukraine, and central bank action for inflation. In 2023, can you blame a reopening China? That's what we're seeing play out in commodities, isn't it? With energy prices, etc. We don't know where that is going to go. Will demand increase in China, more pressure on commodities? Will prices go up there? Is that a concern, a double-edged sword with China's reopening?
So I don't really think so, because China's reopening might not necessarily lead to an inflation jump globally. That's simply because, we also have other parts of the economy now shaping up really well, which is ex-China portion of the economy of the world is shaping up really well. As far as commodities is concerned, you have to look at in two parts. One is oil based commodities, and one is non-oil, which is metal based commodities. Now, When you look at oil-based commodities, then clearly the Ukraine war affected the oil-based kind of commodities or oil itself. But there is now a silver lining as far as the prices are concerned. When I say silver lining, is from the consumption point of view, consumers' point of view, that we have now a new president in Brazil. And if you recall, under Mr. Lula's presidency, the Brazilian oil exploration jump was quite substantial. Probably that will once again be back in the market. With the Ukraine war, as you put it, becoming a footnote, the grip of Russia over the Caspian Bay may not necessarily be so strong anymore. And therefore, we may see higher oil output again there. So clearly, I foresee that oil will taper down as we go into the year 23. Talking on the metal side, yeah, there could be an issue related to China reopening, and that could lead to prices spurting up quite substantially. But let me just put it here that here in the metal space too, we have seen a lot of capacity started coming in other places, particularly in India, particularly Southeast Asia, that should help buttress any supply will be substantial, and it will buttress any consumption peaks that come in. So I
So,
don't see
so then,
inflation
Mahentesh,
or
let me take that question to you. That in what is looking like uncertain times, where the forecast is definitely dismal, are you optimistic, or do you think this is a year that investors need to brace themselves for?
I don't think investors have to brace themselves for anything in this year. Now, we have seen the peak of the inflation pass by. We have seen the Fed rates coming to the rate cycle coming to an end. We are seeing the pandemic obviously closing out now. And we are now seeing the fiscal pressures that are coming on various governments starting to ease, simply because there's been quite a substantial revenue inflow coming into governments. So I'm quite optimistic, despite the dismal scenario that generally gets painted because of the world economy dipping in terms of its growth rate. We will see markets actually starting to bounce back, and therefore investors should not pull back.
Should not pull back. It's an opportunity there. Let me bring this to a little bit of context with Asia and especially India. Manish, in the middle of all of this, we know the broader narrative that Asia will be relatively better, India will be relatively a bright spot. But do you think that some of those headwinds globally will hit domestically as well? And that's what we've been seeing in Indian markets. There's not been a supreme start to 2023 here either.
But if you see, Tamanna, the year that India has had, the Indian equity market in 2022, compared to what is happening abroad and other places, I mean, Indian market has done very well, right, on relative terms. What just tells you that you have a complete delinking, as if you may say, between FII money and domestic money. So domestic investors are getting more into India, and 2022 to me has been a year to show that to investors, that there is a lot of domestic spending and domestic saving which is going into the Indian capital market. And that is the sign of how the Indian capital market is maturing and does not only rely on foreign flow. So that's one thing to really think about, which is very significant. Now, the second is that, is India completely immune? Absolutely not. So whatever happens to US dollar will continue to have an impact on India, because India is still a massive importer of oil, as we know, energy. Now, thankfully, energy prices that India is paying is not very high. And also, I'm sure India has some deals done with various suppliers, which is profitable. So those two things are helping India. If when you're talking about India, it's one clear thing in mind that everyone has to have is investment horizon. So if you're talking in terms of 6 months, 1 year, it's difficult to predict, and Indian market will align with what is happening globally. But if you take a 3 to 5 year approach, then it's very easy to say which market you want to be in, where the growth is, where the savings is going to be, where the fiscal picture is much clearer, where every set of development that's happening, the political stability that India has, compared to other economies, those are hugely positive. So if you're taking a medium to long term approach, then absolutely no brainer that you have to be in India. But be mindful that in short term you might get the whiplash of what's happening in global economy, because India just cannot completely be immune from what's happening abroad.
I want to pull up that chart once again where we just showed you how global indices fared in 2022. And the Nifty 50 was, one of the two in the green, but just about relatively up, just about 1%. So that was what 2022 looked like. Arnab, are we going to see a repeat in 2023, better or worse?
I think for the year as a whole, we'll see a better 2023 than 2022. Risk-adjusted returns, particularly like we were saying, the first half of the year with all volatility, may be somewhat worse than that. But I think the world economy, under the dint of central bank tightening, is still struggling to normalize from the pandemic and the war. And this year probably will be a year of that, more or less of that normalization, right? I think on India itself, I agree with Manish. India is not immune, but I do think it is relatively insulated because it's a more closed economy, and because a lot of the domestic dynamics are quite strong, whether they're about growth in the economy, whether they're about corporate earnings, whether they're about the solution of the twin balance sheet problem that was there a decade ago and was not easily or quickly dealt with, but now appears to have been dealt with. Or whether it's about flows from domestic investors and financialization in India. So I think foreign investors have not been as active as perhaps they wish they had been, perhaps as they should be, and I think they will be more active. And I think that'll apply to corporates as supply chains are reorganized around the world, and will apply to foreign institutional investors as well. So I think the signs are pretty good for India in general this year and over the longer horizon. Although I do agree it makes sense to have a long horizon when it comes to India and other markets, right? I think it's somewhat easier to look at the long term than it is the very short term, perhaps paradoxically, given all the uncertainty and all the shocks that we're still coming to terms with.
I'm just going to take a look at two stocks which were making waves in yesterday's trade. One of them was Tesla, which tanked about 12%. It's up close to 4% right now. Apple up in the green as well, about 1.5%. And both of these in particular hit the headlines because of the impact of China. Huge dependence on the Chinese market, etc. Tesla, of course, with its own concerns as well on management amongst the shareholders. Manish Singh, do you think that this pack is going to continue to be very vulnerable?
See, I think if you look at Tesla, one thing to bear in mind, and of course, Tesla valuations are everywhere. But if you look in terms of free cash flow, which I believe is a strong measure to look at any business that you're evaluating, then on free cash flow basis and free cash flow yield basis, Tesla is still better than GM and Ford combined. If you look, I'm talking about the numbers, free cash flow yield that you're looking at. So as a business, you can't pick fault with that. But given how far the stocks have rallied and the picture that has been built around in terms of EV adoption, the number of cars that Tesla is going to sell, and with growth companies, as you expect, there will be huge amount of rallies and huge amount of setbacks, because that's how the technology companies developed. If you look at early 2000, if I'm not wrong, Amazon had some 3 or 4 over 70% corrections. So I think if you're getting into a growth company in a new economy, in double quotes, given what EV is, then you have to be careful that you are going to get such rallies. I would not be too bearish or too concerned about that. But just I want to make one final point. When we talk about markets and expectations, if it was December 2021 and I had told all investors that there's going to be a war on European land, the inflation will be 8.5%, what would you do? You would go and buy gold probably. And look what gold has done. Gold has been flat for the whole year. if I had said that they're going to blow up the Nord Stream pipeline and all these things, you would have to, oh my God, oil price is going to go through the roof. Emerging market is going to sell off and crash and burn. Look what happened. You've shown the chart. Nifty is at 0.1% and S&P is down minus 19.4%. So we get caught too much in building up stories and expectation. The key thing to focus is when you're investing, keep a medium to long-term approach. Look at political stability, GDP growth, law and everything that goes around it when you talk about property rights. And based on that, you make investments. And that's the approach I like to take. And of course, we have a lot of these short-term updates that we have to do to clients and markets and everything, which was because we have to. But I always recommend everyone never lose sight of medium to long term in picking economies and businesses and not be worried about 10, 15, 20% move here and there, which might happen not because of you, but because there are millions of the people in this market who have different view to you.
Absolutely. Well, thank you to all of you for joining us on the lead story this evening on the India Development Debate.